Picture this. You are on a massive cruise ship. The dance floor is packed. The champagne is flowing. The DJ is playing the loudest music of the night. And everyone, absolutely everyone, is celebrating. The markets are at all-time highs. Portfolios are growing. The news is full of stories about new millionaires being made every single day. Life is good. The future looks bright. And then you notice something. In the corner of the room, sitting completely still, is an old man. 94 years old. Quiet. Calm. Not touching his drink. Not dancing. Just watching the horizon through the window with the kind of focus that only comes from having seen things that younger people have not yet lived through. That man is Warren Buffett. And he is not looking at the dance floor. He is looking at what everyone else is choosing to ignore. The iceberg. Before we talk about the warning, you need to understand the man behind it. Because Warren Buffett is not just rich. He is not just successful. He is the single most studied, most quoted, most imitated investor in the history of human civilization. And understanding who he is, where he came from, and how he built his empire is the only way to truly understand why what he is doing right now should make every person with money in the stock market stop and think seriously. Warren Edward Buffett was born on August 30th, 1930, in Omaha, Nebraska. He did not come from wealth. He came from crisis. His earliest memories were shaped by the Great Depression, a period when banks across America collapsed overnight, when unemployment hit 25%, when families waited in bread lines just to eat. His father lost his job along with almost everyone else. But here is what made young Warren different. While other children saw the Depression and learned to fear money, Warren became obsessed with understanding it. He wanted to know why some people lost everything while others survived. He wanted to understand the rules of the game so deeply that he would never be caught off guard. At age 6, he was already buying Coca-Cola packs and selling them door to door for a profit. At age 11, he bought his first stock. He watched it fall, felt the fear of loss, held on, saw it recover, sold too early, and then watched it climb to 5 times what he had sold it for. That one trade taught him more than most people learn in a lifetime. Buy value. Be patient. Never sell too early. He was rejected by Harvard Business School. Then he discovered that his hero, the legendary Benjamin Graham, the father of value investing, was teaching at Columbia University. He applied, got in, and received the only A+ Graham had ever given a student in his entire career. Graham taught Buffett the most important concept in all of investing, the margin of safety. Buy assets for significantly less than they are worth. Let the gap between price and value protect you from being wrong. Never overpay. Never speculate. Never follow the crowd. Buffett absorbed these lessons like oxygen. And when he went back to Omaha and started managing money in 1956, he turned $105,000 into $7 million in just 6 years. Not through luck, not through tips, through discipline, patience, and a refusal to do what everyone else was doing. In 1962, he began buying shares in a failing Massachusetts textile company called Berkshire Hathaway. He bought it because it was cheap. Then he realized the textile business was dying, pivoted brilliantly, and used Berkshire as a holding company to buy other businesses and stocks and hold them forever. Over the next 6 decades, this philosophy created something the financial world had never seen. A track record so consistent, so superior to every alternative, that academics spent careers trying to explain it. A $1,000 investment in Berkshire in 1965 grew to $48 million by the end of 2025. The same $1,000 in the S&P 500 became $400,000. Both impressive, but the gap between them represents the single greatest sustained investment performance in recorded history. And it was all built on one idea. Buy value. Hold forever. Be patient while the world panics around you. Which is exactly why what Buffett did next is so alarming. Starting in late 2022, something shifted. Quietly at first, so quietly that most analysts missed it entirely. Buffett began selling. Not small amounts. Massively. He sold Apple shares, not a small trim, but approximately 75% of Berkshire's entire Apple position. Apple, the company he had called probably the best business I know in the world. Apple, the crown jewel of his entire portfolio. Sold in enormous quantities. He sold Bank of America, a company he had personally rescued during the 2008 financial crisis and held for over a decade. He trimmed Amazon. He reduced other long-held positions that had made Berkshire billions. And crucially, he did not reinvest the proceeds. He did not rotate into different stocks. He did not buy new companies. He took every dollar and parked it in U.S. Treasury bills. In cash. On the sidelines. For 12 consecutive quarters, 3 full years, Buffett sold more stock than he bought. This is not a portfolio rebalance. This is not a blip. This is a deliberate, sustained, systematic withdrawal from the stock market by the greatest stock market investor who has ever lived. The cash pile grew from $129 billion in late 2022 to $321 billion in 2024. And by December 31, 2025, the final day of his tenure as CEO, Berkshire Hathaway was sitting on $373 billion in cash and treasury bills. A new all-time record. A number so large it exceeds the total market value of 477 out of 500 companies in the S&P 500. $373 billion. Sitting in cash. Not in stocks. Not in businesses. Just waiting. Wall Street had explanations. Of course it did. Wall Street always has explanations. They said Buffett sold for tax reasons, locking in gains before potential rate increases. There is some truth to this. But if taxes were the only motivation, he could have sold stocks and bought different ones. He didn't have to hold cash. He chose to hold cash. They said Berkshire was too large to find meaningful deals. Also partially true. But Buffett made massive investments during the 2008 crisis. Billions into Goldman Sachs. Billions into General Electric. He finds deals when prices are right. He is not finding deals now because prices, in his judgment, are not right. And then there are Buffett's own words. In his final shareholder letter as CEO, writing about equities, he said, "Often, nothing looks compelling. Nothing looks compelling. When the greatest value investor who has ever lived scans an entire stock market worth tens of trillions of dollars and says nothing looks worth buying, that is not a casual remark. That is a verdict. That is a man who has spent 80 years reading balance sheets and calculating intrinsic values, looking at the most expensive market in recorded history and saying, I see nothing I want to own at these prices. And the data backs him up in ways that should stop every investor cold. There is a metric Buffett himself popularized decades ago. It is called the Buffett indicator. It measures the total value of all publicly traded American stocks as a percentage of the country's GDP, its total economic output. Historically, this ratio averages around 85%. Below 70% means stocks are cheap. Above 100% means they are getting expensive. Above 150% is a serious warning. Today, the Buffett indicator sits at approximately 219%, the highest it has ever been. Higher than the dot-com bubble of 2000. Higher than the peak before the 2008 financial crisis. Higher than any point in 150 years of American financial history. The man whose name is on this warning signal responded by pulling $373 billion out of those same markets. Then there is the Shiller-Cape ratio, 150 years of data measuring stock prices against inflation-adjusted earnings. The long-term average is 17.2. Today it sits at approximately 38.8, more than double the historical fair value. And in every single period since 1871 where this ratio exceeded today's level, the S&P 500 delivered negative real returns over the following decade. Every single time. Without exception. 150 years of data pointing in one direction. Two of the most reliable valuation tools in financial history are both screaming the same warning. And the investor who built his entire career on valuation has responded by going to cash. But the warning goes even deeper. And this is the part most financial media refuses to cover honestly. At Berkshire's 2024 annual shareholder meeting, Buffett stood before tens of thousands of investors and said that the United States fiscal situation is entirely unsustainable. He said Berkshire must be positioned to survive scenarios that have literally no historical precedent in American financial history. Think about the weight of that statement. This is the man who wrote, "Why I am not worried about America after the 2008 crisis." The man who spent 6 decades calling American optimism his greatest investment thesis. The living symbol of belief in the United States economy. And he is now saying the fiscal situation is entirely unsustainable and building cash for scenarios without historical precedent. The math is not hard to find. American national debt has surpassed $36 trillion. Interest payments on that debt now exceed $1 trillion per year, more than the entire defense budget. The annual deficit is running near $2 trillion. Congressional projections show interest payments consuming more than a quarter of all federal tax revenue within a decade. These are not political opinions. These are arithmetic. And Buffett, who has been reading government balance sheets for 80 years, can see where this trajectory leads better than almost anyone alive. Now let us talk about the Japan trade, because this is the move that reveals exactly what kind of disruption Buffett is positioning for. Starting in 2020, Buffett quietly purchased stakes in 5 Japanese trading conglomerates: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. By 2023, he had increased those stakes past 7% each and traveled to Japan personally, one of his very few major international trips, to signal long-term commitment. These are not glamorous companies. They are not AI darlings. They deal in oil, natural gas, copper, iron ore, agricultural commodities, physical goods, hard assets, things you can touch, things that hold value when paper assets collapse. He funded these investments by borrowing Japanese yen at extremely low interest rates, a structure that implicitly hedges against dollar weakness and directly benefits from commodity inflation. This is the portfolio of someone who believes the coming disruption will be inflationary. Someone who believes that paper assets will lose purchasing power while real physical things hold their value. Someone preparing for a world where the U.S. government, buried in debt, resorts to printing money to pay its bills. This is not a casual trade. This is a carefully constructed hedge by a man thinking deeply about what the financial world looks like after a sovereign debt crisis. On May 3, 2025, at the annual Berkshire Hathaway shareholder meeting in Omaha, the gathering that draws 40,000 people every year and is nicknamed Woodstock for capitalists, Warren Buffett made an announcement that stunned the room into silence. He was retiring as CEO. Immediately, effective December 31, 2025, the room was quiet in a way it had never been before. 40,000 people who had come to hear his jokes, his wisdom, his reassurance that America would be fine, sat in stunned silence as the greatest investor in history told them he was stepping back. Greg Abel, who had been quietly groomed for years, took over on January 1, 2026. Buffett retained his chairman title and continues to come to the office. He and Abel speak nearly every day. Abel has told shareholders that the cash position does not signal a retreat from investing, that Berkshire remains ready to act, that the money will be deployed when the right opportunity arrives. But notice the careful wording. Not, we see great value in today's market. Not, we plan to invest soon. Just, we are ready when the opportunity comes. We are patient. We are watching. The cash is not indecision. It is preparation. Preparation for what is the only question that matters. History has a habit of rhyming. In 1999, everyone said the internet had changed the rules of valuation forever. Tech stocks with no revenue were worth billions. This time is different, said every analyst on television. And then between 2000 and 2002, the Nasdaq fell 78%. Trillions of dollars of ordinary people's savings evaporated. In 2006, everyone said real estate never goes down nationally. Banks were giving mortgages to people with no income and no assets. Rating agencies were calling toxic securities safe. This time is different, said the banks. And then 2008 arrived and nearly took the entire global financial system with it. After both of those crashes, Buffett was there, buying at the peak of fear, writing op-eds saying, "Buy American," deploying billions when everyone else was desperate to sell, and making extraordinary returns in the years that followed. Now, for the first time in his career, Buffett is the seller. He is not writing op-eds about buying. He is building the largest cash position in the history of his company. And the dance floor is still packed. And the music is still playing. And the Buffett indicator is at 219%. And the Shiller Cape is double its historical average. And the national debt is $36 trillion and climbing. He has seen this movie before, multiple times, and he knows how it ends. So what does this mean for you? For the ordinary person with a retirement account, a brokerage account, savings that took years to build? It means one thing above everything else. The single most powerful lesson Warren Buffett ever taught the world was not which stocks to buy. It was when to buy and when to step back. It was the rule he carried from Benjamin Graham to his first investment partnership to a trillion-dollar empire. Be fearful when others are greedy, and greedy when others are fearful. Right now, others are greedy. Retail investors are pouring money into markets at record rates. Margin debt is near all-time highs. Speculative assets are booming. The mood is pure euphoria. Every market top in history has felt exactly like this moment feels today. Inevitable, unstoppable, permanent. And the man who invented that rule is fearful. He is not panicking. He is not predicting a specific date. He does not work that way. Nobody honest does, because markets are genuinely unpredictable in the short term. They can stay irrational far longer than any rational person expects. But Buffett's positioning is not about timing. It is about readiness. When the music eventually stops, and in the history of every financial market that has ever existed, the music has always eventually stopped. The people holding cash are the ones who survive. The ones who can buy what panicking sellers are desperate to unload. The ones who look back 5 years later and say, that moment of fear was the greatest opportunity of my generation. Buffett built his entire fortune doing exactly that. For times, after the crash of 1973, after Black Monday in 1987, after the dot-com collapse, after the 2008 financial crisis, every single time, the patient people with cash became the richest people in the room. He is building cash again, more cash than he has ever held in 60 years of investing. And he is 94 years old, watching the horizon with the stillness of someone who is not afraid of what is coming, because he has already prepared for it. The ship is still sailing. The music is still playing. The dance floor is still packed. And in the corner, watching the horizon with $373 billion in his hands, sits the wisest investor who has ever lived. He is not panicking. He is not running. He is simply doing what he has always done. Preparing. Positioning. Being patient in a world that has forgotten what patience looks like. The iceberg is out there. He can see it. He has always been able to see it before everyone else. The only question left is whether you will still be dancing when the ship hits it, or whether you will be sitting in the corner, cash in hand, ready for what comes next. That choice, as always, is yours.